All right, everybody. So we were talking about Tesla and this big move made today after the announcement came out about deliveries and production. And stock is, maybe calming down a little bit here. But I want to show you what I'm looking at, okay? This is a shorter term chart than we typically look at. I like to look at 6-month, year charts, but this is a 3-month. And look at this defined pattern over the last 3 months. So this is our 50-day right here. So on last earnings, not this one right now, but 3 months ago, stock popped through there, okay? Right up to this line here, which is the 200-day moving average. Worked its way all the way back down to the 50. Worked its way almost back up to the 200. And then now, just about right back down to the 50. So when I see this here, this is a very short-term pattern. Again, this is 3 months. I'm looking for potentially a short-term type of setup to take advantage of Tesla, maybe not rallying back in the short run, but at least holding this level here at the 50-day moving average. So what I'm looking at right here is selling almost an at-the-money put spread. So selling the 192.5, 187.5 put spread. Could do that for about a $2 credit. Okay, if we do that for $2, okay, what's the outcome of that at expiration at the end of the week? Well, first of all, we know that on any credit spread like that, that's the most we could make. So our positive P&L could be the $2 that we collected, or $200. If the stock drops way below, so below 187.5, which is our long put, okay, then both options would be in the money at expiration. And so the spread would be worth $5, which is the difference between the two puts. This is exactly why I will always trade a spread, whether it's put spread, call spread, any sort of combination, because no matter what, I want to know what my maximum risk is. I never want to go into a trade having open-ended, unlimited risk. So even though, looking at the charts here, I believe that Tesla is going to level off, if it doesn't, I have to be prepared. So that's why I'm not only selling that at the money put, but buying one down below for protection. But if the stock blows through both strikes here, this spread's going to go to the difference between the two strikes, $5, and I would have a loss of $300. Okay? Now, at expiration, what happens if we're right between the two strikes, the 187, 192.5, right? Then what do we do? Okay, I don't want to be assigned on our short put here and have to own stock at 192.5. So what I would do at that point is just make sure I close out the position before expiration, even if it's at a loss. I mean, that's just part of trading. So those are the three scenarios here, but this is the setup that I, really potentially like here, because it doesn't mean that Tesla has to rally back big time in the short run here to make this money. We're just looking for, all right, let's get that consolidation. Let's get that floor in, that support in right around the 50-day moving average. All right, thanks for joining in, everybody. And what you see here is potentially a nice setup for a credit put spread.